Hey everyone, welcome to Silan Smart Finance. Today, we're diving into the history of Japan's bubble economy, the lessons learned, and the incredible journey of recovery and resilience that followed. The danger of stock market bubbles. The history of the stock market provides us with clear lessons. When evaluating stock values, the prevailing ideas and practices among investors can and often do play a crucial role. In such cases, the stock market's operation often aligns with the castle in the air theory. As a result, the game of investing can sometimes be extremely dangerous. Be cautious with new stocks. An important lesson is that investors should be highly cautious when buying hot new stocks. Most initial public offerings, IPOs, typically underperform the overall market. Additionally, if you purchase new stocks after they start trading, you usually pay a higher price, which can lead to losses. Therefore, a healthy investment mindset involves a certain degree of skepticism towards new stocks. In the past, investors have built many castles in the air using IPOs. Remember, the primary sellers of IPO stocks are usually the company's management. They seize the opportunity to sell their shares either when the company reaches its peak development or when investors are fervently chasing a popular trend. In such cases, investors rushing to follow the trend, even in high-growth industries, often find themselves busy with unprofitable pursuits. Not only in the US, but other countries have also experienced similar bubbles. In the late 20th century, Japan's real estate and stock markets experienced a massive bubble. From 1955 to 1990, Japan's real estate prices surged over 75 times. By 1990, the total value of all Japanese real estate was close to $20 trillion, representing more than 20% of global wealth, or twice the total market value of global stocks. Theoretically, selling the imperial palace and its land in Japan at assessed value could raise enough funds to buy the entire state of California. Japanese stock prices also soared like helium balloons in calm weather. From 1955 to 1990, stock prices rose by 100 times. In December 1989, Japan's stock market peaked, with a total market value of $4 trillion, almost 1.5 times the value of all U.S. stocks and close to 45% of the global stock market value. Such figures left investors adhering to the solid foundation theory in shock. They read in the papers that Japanese stocks had P/E ratio of over 60 times, nearly 5 times book value, and more than 200 times dividends. In comparison, the P/E ratio of U.S. stocks was about 15 times, and the London stock market's P/B ratio was 12 times. When comparing individual companies, Japanese stock prices were even more astronomical. For instance, during this frenzy, Japan's telephone giant NTT, after being privatized, had a market value exceeding the combined value of AT&T, IBM, Exxon, General Electric, and General Motors. Despite all reasonable objections, proponents of the stock market rise always had ready responses. Were P/E ratios soaring into the stratosphere? No, said securities marketers in Kabuto-cho. Japan's P/E ratios are still undervalued compared to the US because Japanese companies overstate depreciation charges, and earnings from affiliate companies aren't included in the parent company's earnings. Adjusting for these factors, the adjusted P/E ratios would be much lower. Was a dividend yield below 0.5% unreasonably low? The answer was that this reflected Japan's low interest rates at the time. Was a stock price 5 times asset value dangerous? Not at all. The book value of assets didn't reflect the significant appreciation of land owned by Japanese companies. They explained Japan's high land prices in two ways: high population density and regulatory and tax restrictions on land use. However, all these explanations were untenable. Even adjusting company earnings, Japan's P/E ratios remained significantly higher than other countries' levels and vastly inflated compared to their historical averages. Moreover, Japanese companies' profitability had been declining, and a strong yen was bound to make Japanese products less competitive abroad. While land in Japan was scarce, Japanese manufacturing companies, such as car manufacturers, found ample and attractively priced new factory sites overseas. The rise in rental income lagged far behind the rise in land values, indicating a declining return on real estate. Finally, the low interest rates that had been supporting the market began to rise in 1989. Some speculators concluded that the basic principle of the law of financial gravity didn't apply to Japan. However, to their dismay, Isaac Newton visited Japan in 1990. Interestingly, it was the Japanese government that caused the apple to fall. The Bank of Japan, BOJ, seeing the lending frenzy and liquidity boom fueling soaring land and stock prices, and the consequent general price increases stirring public unrest, began controlling credit and raising interest rates to curb further increases in land prices and to cool the stock market gently. The stock market did not achieve a soft landing, but instead collapsed entirely. The stock market decline was almost as severe as the U.S. crash from late 1929 to mid-1932. On the last trading day of the 1980s, the Nikkei index peaked near 40,000 points. By mid-August 1992, it had fallen to 14,309 points, a drop of about 63%. In comparison, the Dow Jones Industrial Average fell by 66% from December 1929 to the summer of 1932, although it fell by more than 80% from September 1929. The dramatic rise in stock prices in the late 1980s reflected changing valuation relationships, and the subsequent decline from 1990 indicated a return to the valuation ratios typical of the early 1980s. In the early 1990s, Japan's real estate bubble also burst. Various assessments of land prices and property values showed that the real estate market decline was as severe as the stock market collapse. The burst of the bubble shattered the myth that asset prices in Japan would always rise. The law of financial gravity does not recognize geographic boundaries. After experiencing the painful lessons of the bubble burst, it took Japan's stock market several decades to gradually recover. In response to the crisis, the Japanese government and the BOJ took a series of measures. After the bubble burst, the BOJ quickly adjusted its monetary policy, employing various means to stimulate the economy. Interest rate cuts. The BOJ significantly lowered the benchmark interest rate, bringing it close to zero. This ultra-low interest rate policy aimed to reduce borrowing costs, encouraging business investment and consumer spending. Quantitative easing. The BOJ implemented large-scale quantitative easing, purchasing government bonds, corporate bonds, and other financial assets to inject substantial liquidity into the market. This aimed to lower long-term interest rates and encourage borrowing and investment. Negative interest rate policy. In 2016, the BOJ went further, implementing a negative interest rate policy, charging interest on excess reserves held by commercial banks at the central bank. This was intended to encourage banks to lend more money to the economy, increasing loans and investments. The Japanese government pushed a series of structural reforms aimed at enhancing economic vitality and market transparency. Deregulating financial markets. By loosening entry restrictions to financial markets, the government attracted more domestic and international financial institutions, enhancing market competition and efficiency. Encouraging mergers and acquisitions. Policies were introduced to encourage corporate mergers and acquisitions, increasing industrial concentration and resource allocation efficiency, thus boosting corporate competitiveness. Improving corporate governance. Through amendments to company laws and related regulations, the government promoted better corporate governance, increased transparency and accountability, attracting more investor trust and participation. To prevent future bubbles, financial regulators strengthened market oversight. Enhanced information disclosure. Listed companies were required to regularly disclose financial conditions and business performance, increasing market transparency and helping investors make more informed decisions. Cracking down on insider trading. Efforts to combat insider trading and market manipulation were intensified, ensuring fair and just market operations. Protecting investor rights. A series of investor protection regulations were enacted and enforced, ensuring effective protection of investor rights and boosting market confidence. Japan actively participated in international financial cooperation, enhancing market internationalization. Free trade agreements. Japan signed free trade agreements with multiple countries and regions, reducing trade barriers, promoting economic growth, and opening up markets. Attracting foreign investment. By easing restrictions on foreign investment, Japan attracted more foreign direct investment, enhancing market liquidity and vitality. International financial cooperation. Japan actively engaged with international financial organizations and multilateral cooperation mechanisms, elevating its status and influence in the global financial system. Through these efforts, Japan's stock market gradually stabilized and began to recover in the early 21st century. Although it has not yet fully returned to its bubble-era highs, the valuation levels and investor confidence in Japan's stock market have significantly improved. Investors have learned crucial lessons from this history, focusing more on fundamental analysis and risk management, avoiding the blind pursuit of trends and bubbles. Today, after 30 years of adjustment and recovery, Japan's stock market has once again become a focal point for global investors. Despite challenges such as an aging population and slow economic growth, the stability and opportunities brought by Japan's reforms continue to attract global investment. In 2020, legendary investor Warren Buffett, through his company Berkshire Hathaway, made significant investments in Japan's 5 major trading companies: Mitsubishi Corporation, Mitsui & Company, Itochu Corporation, Sumitomo Corporation, and Marubeni Corporation. This move surprised the market and demonstrated Buffett's confidence in the Japanese market. Buffett believes these trading companies are undervalued, with solid earnings and good dividend returns, making them excellent long-term investments. Over the past 30 years, Japanese companies have adopted several strategies to survive market downturns and gradually recover, improving efficiency and innovation. Many Japanese companies remain competitive in global markets by improving production efficiency, increasing R&D investment, and driving technological innovation to enhance their competitive edge. Globalization strategy: Japanese companies have actively expanded overseas markets, reducing reliance on the domestic market, thus spreading risks and enhancing resilience. Strengthening corporate governance: over the past decades, many Japanese companies have strengthened corporate governance, improved transparency and management efficiency, gaining the trust of investors. Stock buybacks: to enhance shareholder value, Japanese companies have frequently engaged in stock buybacks in recent years, stabilizing stock prices, increasing earnings per share, and demonstrating confidence in future growth. These strategies have not only helped Japanese companies weather market downturns, but also enabled them to maintain competitiveness in the global market. Facing Buffett's investments, Japanese companies have actively responded by strengthening communication with global investors, further boosting market confidence and attention. The history of Japan's stock market teaches us that rationality and caution are essential in investing. Blindly chasing trends and bubbles only leads to risks and losses. However, through active reforms and strategic adjustments, Japan's stock market has gradually recovered from prolonged stagnation and regained the trust of global investors. In the future, Japan's market will continue to be a key focus for global investors, deserving long-term attention and study. I hope you enjoyed this trip down memory lane and picked up some valuable investing lessons. If you did, smash that like button, subscribe to my channel, and hit the bell icon so you never miss a video. See you next time on Silan Smart Finance.